Luxury hotel exits rarely fail because performance collapsed. They fail because value was never cleanly transferable. At exit, buyers do not pay for yesterday's results. They do not pay for leadership brilliance. And they do not pay for brand reputation in isolation. They pay for certainty. Certainty that what exists today will still exist the moment ownership changes. This is where many luxury assets quietly lose exit value, even while operations still look strong. The core exit question is not, is this hotel performing? It is, what exactly am I buying that survives transition? What continues without the current owner? What remains if leadership changes? What still works in a softer cycle? If those answers are unclear, the exit multiple is discounted, regardless of today's numbers. Exit pricing is not emotional. It is structural. Many luxury hotels approach exit with strong surface metrics. Healthy EBITDA, stable ADR, consistent occupancy. But buyers immediately look past this and ask a different question. What breaks the moment we take over? If the answer is relationships, personal oversight, informal decision-making, unwritten experience logic, then the asset is operationally strong, but structurally weak. What performs today does not automatically survive tomorrow. Exit pricing reflects that gap. Many sellers assume a strong brand guarantees a premium exit multiple. Buyers do not see brands that way. They separate brand perception from economic leverage. If pricing power depends on discretionary spend, if standards are rigid but margins are not, if brand affiliation limits flexibility, then brand strength does not anchor the multiple. It compresses it. A brand that cannot be economically defended becomes a cost structure, not a multiplier. Exit buyers do not pay only for stable cash flow. They pay for strategic optionality. If an asset has limited repositioning paths, cannot recalibrate pricing without brand risk, cannot rebalance costs without experience dilution, then future scenarios narrow. And narrow optionality always means a lower multiple. Stable but inflexible assets are priced defensively. The most dangerous phrase in exit discussions is, the next owner can build on this. Capital translates this immediately as, the value is not finished yet. Finished assets command premiums. Unfinished stories invite discounts. If the exit thesis depends on potential rather than inheritability, the multiple will reflect uncertainty, not ambition. Exit multiples hold in luxury hotels when emotional value is systemized, pricing power is defensible without storytelling effort, cost structures tolerate stress, brand promise survives leadership change, and experience remains intact across ownership cycles. This is not branding. This is not operations. This is asset architecture. Luxury hotels do not lose value at exit because they are weak assets. They lose value because their strength cannot be cleanly handed over. Uncertainty does not show up in operations. It shows up in the multiple.